Exam on Thursday. 2 essays are open books, so you put them on Blackboard by 9 o'clock. They're on Blackboard under content, class content at the bottom. Some have already submitted them. I did put it unlimited submissions, so if you submit it and you change your mind, you want to change it, you can still submit. I think there's 4 or 5 of them out there. Getting them to me early doesn't help me any, but it's fine if you want to do that. I won't start grading them until Friday. The first one is the ethical challenged one. And you're not agreeing with me for putting the answer down, but I knew you need to put all the points down. You can, if you want to spend time debating the other side, that's perfectly fine. You should have done that in class, but you can do it on an exam if you want to, if you've thought of stuff since the class. So this is not necessarily a rubric. It's just make sure you cover these points. I don't grade on whether you cover the points or not. I grade on the depths with which you cover the points. So the 2 disintermediations, they're related to what? High interest rates, strong stock markets. So one disintermediation is going to banks, the other one's going to stock markets. Insurance companies, how do they compete? Well, they said, you know what? The money's in asset gatherers. We're going to become an asset gatherer. The problem is they're not good at that. They're too expensive. That's not what they're set up for, insuring lives. That's what they're made for. They're competing in a world where their competitors are much cheaper. So they have to somehow figure out how to compete. There's overcapacity. There's really a couple of things in this third bullet. They're higher expensive and there's too many insurance companies out there. How do you handle that? Most industries handle that by just consolidating. People going out of business, they didn't do that. The insurance industry said, you know what? We can compete by making our products so complicated, no one has a clue what they're buying. And so they made it with complexity. And this is a really important point. This point is actually in both questions. You remember when you do term versus perm, what's the huge advantage of term? It's just very easy to do comparison shopping. How does the insurance industry get away with these horrible products and make them really hard to compare one to the other? So you see that in both. In fact, what I do on the exam, if a student really answers it well on this question and leaves it out of the other one, a lot of times I give them credit that they brought it up and forgot to put it in the second question. But the best thing, it belongs in both questions. It really does. Information asymmetry. I'm not sure the symmetry is all as great as we make it out to be, because I'm not sure the salespeople understand these products that well, but they at least understand them better than the person they're selling them to. Capitalism works really well when buyers and sellers have equal power, but when one side has a lot more power than the other, you can have all kinds of fraud going on. And then obviously how they're trained and how they're compensated. That's my big thing. I don't think any financial product should be sold on commission. That's just my opinion, but you know, you can certainly debate that. If you're worried your exam's going to get to your boss's desk, don't worry, you know, it's all confidential. So you're not saying, or just say blah, 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 which I don't agree with this, but blah, 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 blah. And yeah, that's perfectly fine. I talked about this with Danya. You sell the product based on all its tax advantages. And then when the tax advantages blow up, you say, hey, we don't give tax advice. You're on your own. Again, I think if the insurance company is ever going to say consult your tax attorney, they should have said that when they sold the product. That's just my opinion. If you're ever going to say that line, say it when you sell it. So, hey, here's a product. It's pretty complex. It has tax advantages. You might need a tax attorney at some point with this product. That would probably scare most people off. So if you're ever going to say it, say it the time you sell it. I know what the industry would say to that, but still, I think it's what should be. And then stochastic dominance. Most students get almost no points here. They end their essay with, oh, and by the way, stochastic dominance. Like, okay, that doesn't tell me anything. What is stochastic dominance? You take this product and you take a much simpler product, you run 1,000 simulations, and the simpler products win 98, 99% of the time. And even when they lose, they don't lose by much. You got to explain that whole thing. All right. I actually have most of it there. And most students just don't, I don't know why they don't spend time. We're not talking hours here, 20, 30 minutes just sitting thinking about it. You can give me a pretty decent answer. But yeah, a lot of students lose points there. I guess they just don't want to waste their time. Surely he'll give me full credit for just saying stochastic dominance, but I won't. How do I grade these papers? I grade the papers as if the interviewer asks you this question. And at the end, I'm wondering, would I hire this person for this job? Do they sound like they know what they're talking about? Okay. So that's how great would I be proud that if I heard you answering this question in an interview, or would I be like, well, don't tell them you took my class? That's how I'm looking at this. All right, questions on that first one? Now, if you brought this up in an interview with a life insurance company, you're probably not going to get the job. Some of y'all have already had that experience. Don't ask me about ethics. I want to know if you can sell a product nobody wants. That's kind of what they want to know you can do. So they don't want you to say this stuff. I want you to know this stuff because I think it's going to have an impact on what firm you're going to want to work for. There are very ethical firms out there in this industry, but this is the kind of stuff you want to ask. All right, y'all good on that one? All right, the second question is the more complicated one, mainly because I didn't help you. I threw out just stuff that I got from the internet and worded the arguments. It included all the arguments I would include. You've got to take that part of the notes and you got to reorganize it into a sensible answer. So it's a little bit challenging. But the arguments for term, separation and control, lower costs, front end the load, insurance when you need it, simpler for comparison shopping. Just put extra words to this to fully explain it. All right. Whole life, you may need insurance later. And the forced savings, because most people that buy term and invest a difference, they don't invest a difference, they spend it. So whole life forces you to have that savings element. For both of them, I actually think whole life does better for withdrawing funds because you can borrow the funds and it doesn't affect taxes. But both of them have those issues. And then this last one, I'm going to show you an article here that brings this up. Whole life does have a much lower return, especially for young people. Whole life is essentially investing in a low risk bond. It's true life is going to give you a much lower return. But the argument that you should be in the stock market because you get higher returns, it's true, but it's much riskier. Whole life is a very low risk product. Even if the life insurance company goes under, you still have protection from the state of Texas that's going to bail you out. So it's a lower risk product. It's not going to fluctuate around the way the stock market does. And then you got to do the graphs. And some students lose a lot of points here. So you got to show the graphs. Make sure you have the correct graphs. I have at least 2 or 3 students. Get to it here. There you go. Fine. This is not the graph. All right. It's not this one. It's not the one on page 20. That's not the graph we're talking about. And I don't even know if the graph we're talking about is even in the notes. I think it was in a separate document. Let's see. Maybe I did put it in the notes. Yeah, it's the one on page 26. So you need to show 2 of these graphs. The advantage, since it's open book, is you can actually copy the graphs and put them into your paper. If you want to show all 4 of them, that's kind of overkill, but you can. But you have to explain the graph. Right? Explain the whole life, explain the term. Why does the term drop like this? So with the whole life, you're paying a premium and you have insurance as long as you pay the premium if you die. So the graph is showing you what you get if you die. Whole life's pretty simple. You pay the premium. If you die, you get the face of the policy. So the term, you got to put more thought into it. So what the term is saying, your term premium is much, much lower. So you have an extra couple $100 that you can invest every month. If you die, you're going to get the face of the policy plus whatever that investment is. But then what happens right here? The term ends. It's a 30-year term, so the term ends, and then all you have is your portfolio. But you get to invest a little more now because now you're not even paying the term premium, and you're investing at 3%. Eventually, you're going to end up with more money than if you had the whole life, assuming you do what? You invest a difference. If you don't invest a difference, what do you have? You have an orange straight line to here and then 0. You don't invest the difference. You have $250,000 of insurance and then nothing. So this assumes you invest that entire difference.
All, are you investing not the difference, but the difference plus the premium?
Yeah, you're investing 100%. Yeah. If you had a $35 premium and the whole life was $335, then you're investing $300, and then you're investing $335. I think when I first did these graphs, I forgot to add the $35 in, but these I did update them to use. These are actual numbers. I'm using mortality tables just like we're going to use later in the class. So, all right. So some students grossly under explain these charts. So make sure you give me a full explanation. How do you know if you have a full explanation? Then show it to your roommate. Say, does this make sense?
Which premiums? Whole life premium.
Well, the whole life premium's $335 the whole time. The level term is $35 for 30 years and then zero because you don't have any insurance. So you're investing $300 because the whole life is $335. The term is 35. You're investing $300 for 30 years and then $335 for the rest. Yeah, some students make the mistake that it's like, my professor already knows this, so I can just summarize it. And it's like, you know this, but I'm not grading me. It's your paper. So you got to convince me you know it. So don't over summarize it. Go overboard. If you're like, I'm not sure I need to put that in, guess what you should do? Put it in. All right. Go overkill, go overboard. So some students way too summarize. Same thing here. You know, if you're being interviewed on this, can you prove to me you understand this in great depth? Why do I say that? Because the students that do that email me a year or two later. It's like, wow, I just had an email yesterday or today. I got an email. Yeah, now see why you do exams like you did. Boy, that really helped me in this interview. It's like, you got to get to that level of depth that you really, really understand it. All right. Questions on that one? If you're not sure, you can call me. I'll be on my bike tomorrow morning. You can call me. I may not be on my bike at 7 a.m. tomorrow because we're up so late tonight, but by 8 o'clock, I'll be on my bike. It's been really pleasant recently. I've actually had to put on sweatshirts, go bike riding. I didn't even need gloves. I couldn't find my gloves. Like, where are my gloves? I gotta go. They're buried under a bunch of winter clothes somewhere. So yeah, if you want to talk you through it. I won't tell you exactly what to say, get an A, but I'll definitely tell you, no, you need more there. That's not strong enough. You're missing some stuff. I'll definitely tell you that. And then the last question is the annuity problem. You have a couple of examples already. You can go to my prior classes if you want more examples and watch those those YouTubes. So I'm not going to work another problem in class. You should have this down. It always amazes me that 100% of students don't make 100% on this question because it is exactly like we did in class. But there's some students, and this one you're going to work in class, some students just have exam anxiety, and it's like I can't remember any of it. Couldn't do it. So don't do that. Practice enough, work it enough times that you're ready to go. There's not going to be any surprises on that question, I can assure you. You can't use Excel. You got to use a calculator. Make sure you know how to plug all this stuff into a calculator. All right. All right. So that's the exam. Everybody's ready. So class, once you finish on Thursday, you're done. We're not going to have class after the exam questions. So that's all we have on Thursday. My thought is you're spending all the time on the essay questions. So you're doing that. That would have been normally class time. All right.
Do you want first few questions? Do you want them like in the column format?
You can, but it doesn't really matter. However you want to do it. All right, so let's jump down. Well, let me show you. I want to show you this article because I thought it was kind of interesting. Very interesting. Actually, I found several articles. Oh, why did he just pass them up? Did he? Anybody see that? Wow, that's great. Now the controversy, right? Is he the true record? All that kind of stuff. All right. I don't watch Major League Baseball, so I wouldn't. I've been to Major League games, and boy, they bored the tears out of me. I want college football. Give me college football. All right. Does whole life insurance make sense to buy? What was your answer be for that? What does every economist say to every question? It depends. But let's look and see if they explain it very well. Building financial security for your family is achievable in numerous ways. You can have a college fund. What do y'all think about college funds? I'm not a big college fund fan. Why do y'all think I don't like college funds? I sound like Jack Bogle all the time. Too many expenses, way too many expenses. USA had these things. Well, I'm going to put this on the internet, but I don't care. Oh, I thought they were terrible. I was embarrassed that I was responsible for these things. It's like, why do we have this extra level of fees? Well, they get all these tax advantages. Oh man, it's not worth it. Your 401k plan, all that kind of stuff. You can consult with a financial advisor. Yeah, if you want to spend a couple $1,000, you can. Whole life is a policy that gives coverage for the rest of the policyholder's life. That kind of makes sense, meaning the death benefit never expires. I like term. That's so far so good. The policyholder pays a monthly premium, part of which insurance adds their cash value. That's true. It's part savings, part insurance. The savings account accumulates over time. While it can provide more protection, it is more expensive than other life insurance options. It's more expensive than others and it's cheaper than others, but it's more expensive than term, obviously. Why? Because they got to insure you. They're going to pay you $100,000. It's a sure bet. With term insurance, they may not pay you anything. So that's why it's more expensive, right? You buy term insurance for 20 years, there's a really good chance you're still going to be alive in 20 years. Whole life, you know, with 100% surety, you're going to get 100,000, so you keep paying the premium. Multiple types of life insurance. So they have whole life. Your death benefit remains active as long as you pay. In addition, premiums can return to the cash value. Usually grows at a rate between 1% and 2%. I don't know where they got that. I think that's true 2020 and 2021. I think right now they're probably starting to pay 3% and 4% now with interest rates much higher. Person whole life. Now, whole life, they pay similar to the universal life. They're going to pay a little less than universal life because they have to keep that payment in there for the rest of your life. Whereas universal life, they can reduce their crediting rate. So if universal life is paying 4.5%, whole life might pay 375, 380. So it's going to be lower, but it's going to come. They're not going to pay you like 1% and universal life's paying you 6%. It's not going to be that far off. But they do hedge some of it because they're fixed they can never change that. The government doesn't tax whole life, so that's a huge tax advantage. Most often life insurance require medical exams. So yeah. Generally those policies pay out a maximum 20%. So universal life, like whole life, these policies have cash savings. However, policy holders of universal life might be able to modify their death benefit. That's really not all that wonderful thing. The savings account can invest. Now, this is not true. What word are they missing up here? Universal life does not move with the stock market. Yeah, variable universal life. Now, there is equity linked universal life that's tied somewhat to the stock market. But you have to have either equity linked universal life or variable universal life. Universal life just by itself without those two other terms does not tie to the stock market. It gives you more opportunity for growth, but what else does it do? Variable universal life is much more volatile. You can lose a lot of money. In terms of return on investment, life insurance isn't the most profitable asset. That's true because it's not very risky. You want more return, you got to take more risk. I remember the email I got at USAA. This guy was all upset because he lost money in the stock market. And he said, I bought stocks because they're riskier so I can get a higher return, but I lost money. And he said, doesn't make sense to me. I thought I was going to make more money. And I was like, yeah, that's the lost money. That's the risk part. It's more risky. He didn't understand that. He thought I'm taking more risk, so I always make more money. If you always make more money, then there's no risk. There's no risk there. So you have to, life insurance, you're not going to lose money on whole life. They're never going to take money out of your cash value. It's always going to grow higher. Can you get 7 to 10% out of your IRA? No, you're not going to get 10% out of your IRA. Typically, between 5 and 8%. Yeah, you're just not going to get those kind of returns. If you have cash left after contributing to the highest allowed retirement account, life insurance might be worth considering. I agree with them. You really should load up on the tax advantage assets. Whole life is tax advantage. But for a young person, yeah, you're making 3.5%. Yeah, you probably should be heavily allocated to stock market. But I do think there's a purpose for whole life. Technically isn't an investment. It can be wise. So they keep saying it can be, might make sense, can supplement. So they're not making a strong push for it. If you're really low risk tolerance, then whole life might be a good option. It can be participating where you get some dividends every once in a while. Your monthly premiums never change. Remember, that was a big problem with universal life. Interest rates fall and stay low, universal life, your premium can double, triple, quadruple. How to have access to your cash value, you can get access to it. They make the argument that if you access it, you're gonna have this big tax penalty, but as long as you pay back that loan on time, there's no tax penalty. So it can be a really, really good way to get access to it. If you no longer need the policy, then they say just take the cash value. What did I say? Don't take the cash value. What do you do instead? You go talk to a viatical company and see if you can get more. You never just surrender life insurance, especially if you're over 60 years old. Now, if you're 27, yeah, cash value is probably the best you can get, but there's probably not much cash value there. I might still check with it about viatical, but viaticals, they're usually the place to go when you have older people like me. That's when you say, hey, you know what? My cash value is 20,000. The viatical pay me 30,000. I might as well get the 30,000 from them. So anyway, it's a decent article. I don't think it. My parents should have bought whole life instead of universal life. This article doesn't explain that. They should have spent more time on universal life and the downside of universal life versus just saying universal life usually can maybe buy in the stock market, which isn't actually true. So interesting article. I had this annuity article. Fidelity is all excited that they have these contracts with life insurance companies that your 401k plan, they can go to some life insurance company and give you an immediate annuity. And they're like this wonderful, wonderful thing. I don't know why it's all that wonderful. You could take your 401k and go to the life insurance companies yourself if you wanted to. So I'm not sure what they're doing for you. Maybe there's saving the hassle of having to do the exchange. But anyway, they made a big deal about it. It's kind of nice to get an article in Yahoo Finance, which is essentially an advertisement for Fidelity. That's the best kind of advertising. It doesn't cost you anything, and it sounds really honest because someone else wrote the article about you. So anyway, free advertising. I have found this article on Social Security. Social Security is slowly running out of money. So what should you do? Is she worried about Social Security? She has nothing to worry about. Maybe her great grandchild is going to worry about Social Security, but she has nothing to worry. It looks like she's really pondering, but she has nothing to worry about. I don't know what she's growing over here, but yeah, she has nothing to worry about. So I'm not as worried about Social Security. Is actually, I think, easier to fix than Medicare. We'll talk about Medicare. I think Medicare is a disaster, but I think Social Security, yeah, they're going to push your retirement ages back, but pushing your retirement age back is actually a huge benefit to Social Security. It really is quite dramatic. So should you be scared? Remember, I don't know if I talked about in this class. A question as a title is really quite powerful. If you want someone to read your article, start it with a question. Have your link be a question. People love the link. Like, I mean, don't you want to read this now? Should you be scared? If your benefits are reduced by 20%, the average 35-year-old millennial current earnings will lose an estimated $13,000 in Social Security. You're probably going to get something from Social Security. It'd probably be less than you're expecting. I actually think the biggest thing they're getting is going to push you back to 75, 80 years old. They're probably not going to get you benefits at 62. I think that's the most likely, and that's huge. Because if you're going to die at 90, pushing it back to 85, that saves the government a tremendous amount of money. They go through all these numbers, but I don't think y'all are even thinking about that. And then they say fill the gap. Well, that's what we're talking about. You gotta buy investments to make up that gap. So some interesting articles. Article on pensions and markets. So yeah, there's some. Every time I see a lot of articles talking about the stuff we're doing in this class. Okay. Questions on anything? We're about to get into health insurance. So before we get into the papers, we're gonna just do some introductory, and then we'll get into paper. Hopefully tonight we'll get into the paper. So I know you all are ready to get working on this paper. So the health insurance industry includes commercial insurers. It also includes Blue Cross Blue Shields. You can hardly tell the difference anymore between those two. It also is these HMOs, PPOs, those type of firms. You can hardly tell the difference between those anymore. I used to make a big deal about these, but they've gotten so that you almost, when you sign up for your benefits at your employer, you may not know which of these that you have. Now, I know at UTSA, I have Blue Cross Blue Shield because that's what's on the little card they give me. USA had Blue Cross Blue Shield. I don't know what they have now. But it's hard to tell which of these you have. The commercial insurers have really merged together and have consolidated. So there's just a few really massive players. And some of them do both health insurance and healthcare. So it's really even hard to tell there. This used to be a really important issue. It's not such an important issue today. But the debate today is private versus public. Most people say US versus Canada. I think it's actually US versus the UK. We hear about Canada because we're right next to them, but usually the UK is the one that's set up as the government run. The NHS in UK. The word is the US is a mess and UK is perfect. But I can show you all kinds of articles of how the UK is seriously in problem. Everybody, there's no place in the world where healthcare is just this wonderful thing. Costa Rica got a wonderful article. I go to Costa Rica all the time. They got a wonderful article about their wonderful national healthcare, and I thought it was really, really good. And then there's a farmer that's one of our partners. We do micro lending there. He had a special needs child born, his daughter. And Costa Rica said, good luck with that. We're not helping you. And it was horrible. We did a GoFundMe here in the United States and raised like $20,000 because it was just ridiculous. This poor farmer, making maybe $5,000 a year. And he had $20,000 of healthcare bills. And he had socialized healthcare from his government. They said, fine, get cancers, we'll help you. Break a leg, we'll help you. Special needs child, you're on your own. We can't help you. It's really sad. I mean, how sad, let me tell you how sad it was. This daughter she was having a lot of seizures, which is really scary. For a new mother, when you think that's really scary, but they're not going to pay for her ambulance. So she's got a daughter having seizures. She's got to ask, do I call the ambulance? And that's going to take 2 months of income. Or do I get on the public bus and take her? So she has her daughter on the bus having seizures and the whole bus is looking at her. That's really sad. You shouldn't do that to someone. So even Costa Rica with its socialized medicine. So no, I can't think of any country that has this thing solved. Maybe Sweden. Maybe we should all visit Sweden and see how they're doing. But UK, I'm going to put UK as the one most people talk about, and they have some serious problems. So when you write your paper, you can do Medicare for all if you want to, but you still have to go through the entire thing. You can't just have one paragraph, Medicare for all, period, I'm done. You got to go much more in depth than that. So the majority of the US is already socialized medicine. 70% or more of the United States is Medicare, Medicaid, and Veterans Administration. That's on the payments, not on the number of insureds. The majority of the number of insureds is private, but the actual payments is Medicare. And why is that? Because when you turn 70, your health care goes up dramatically. You might go 20 years of your life in your 20s and 30s with almost no medical expenses. But then when you turn 70, I think my grandfather, he probably spent 90% of his healthcare in his last month of his life. We're going to talk about that. So while Medicare doesn't insure the majority of the Americans, the payments, the actual cost of healthcare is 70% of that goes through them. Medicare does what? Insurance or care? How many medical services does Medicare provide? They own hospitals, rehabs, so none. They're all insurance. What about Medicaid? 100%. insurance. What about Veterans Administration? It's both. So if you have that military friend of yours that's like anti-government, I hate communism, hate socialism. So yeah, well, you have the most socialist healthcare in the United States. You can't get more than that. They got some pretty bad rep the last several years. They have this new, I think the lady running now, I think she just won an award for fixing the VA, kind of quietly doing it behind the scenes. I'm not sure exactly what she did, but I've been to the VA. I had a friend who passed away in a VA hospital. It was really sad. I have to admit, I would not want him to have died like that. It was kind of sad. But I don't know if it's that particular hospital or if there's not much more they could have done for him. I don't know. But he was cared for. He wasn't, he was in a bed, nice hospital, but he was sharing a room with several other people. It was kind of a sad way to go, but he was military and he was taken care of to the end of his life. So that's a big part of the US system. If you want this to be 100% of the system, then yeah, we got to talk through that. So if you want to add strength to your paper, I don't know what Bernie Sanders has on his website. How do you spell Bernie Sanders? There it is. It came right up. Do you think his site will be the first one? Is he paying Google? Or is the first one going to be Fox News? Or there it is. So remember, 10% of your paper is other research. This is the kind of thing you can do. Even if you hate this idea, you can go to his site and say, hey, Bernie Sanders is arguing this. I'm not going to get into his Medicare for all. We're all going to talk about Medicare somewhat. You just have to. You have no choice. It's kind of the gorilla in the room. Making healthcare a human right. I'm not real sure what that means. I've seen that before. But smart guy. I like Bernie Sanders. I like politicians that know exactly what they believe and they're bold and they say it. Even if I disagree with 100% what they say, I like politicians that say what they believe. It kind of refreshing. And there's no like, what does he think about this? This is what he thinks about that. So there is those kind of stuff is perfectly fine. I like that kind of analysis. Most other people are covered by their employer. We're going to question that. Should you be covered by your employer? Do you want your provider, your employer providing you auto insurance, providing you health insurance, life insurance, disability insurance, groceries, YMCA membership dues, your housing? You want your employer, what all do you want your employer to provide? Why does your employer provide you health care but not housing? Is it obvious that your employers provide health insurance? You expect it, but is it obvious that you should do that? Should they provide you a car? Should they provide you, why do you provide some things and not others? So we'll get into that. You're going to find my bias. So I'll tell you my biases now. I have strong biases. And I'm absolutely convinced I'm wrong in everything I believe. So I'll throw those two things out to you because the world's far too complicated. I'm not nearly smart enough to have anything right. But I do have strong opinions. At least I'm not like your Facebook friends who have strong opinions and they're omniscient. Those are the ones, that's what irritates me. So I have strong opinions and I know I'm really stupid. But I don't like employer provided health insurance. I don't think employers should provide health insurance. I think you should buy your health insurance yourself separately, but we'll get into that. I'm going to show you the math behind that. I'll give you my arguments and you can argue the other side. Not only do I believe that, and I'm fairly far to the libertarian side, but if you go to President Obama and some of his advisors, that's also was their goal. There's one advisor, I might quote him because I think I have some quotes from him that he says, and yeah, we got to get rid of employer provided health insurance. You're going to find the first two articles you're going to read. One a far right Republican, one a far left Democrat. They're both going to say we got to get rid of employer provided insurance. Isn't that interesting? Everybody believes it, but whom? Congress seems to be the only one, but we'll see if I can convince y'all or y'all can convince me. We'll see. All right. Now, traditional plans and indemnity plans That's the way I did my insurance. Indemnity plans is just like your auto insurance. Small stuff, doctor visits, those kind of things, you pay for that. That's just normal. But those high expenses, surgery, broken legs, those kind of things, the insurance pays for that. So how many oil changes does your auto insurance pay for? None, ever. So an oil change is kind of like a doctor's visit. So that's an indemnity plan. It just reimburses you for those big unexpected expenses. Now, the second article, that's going to be his argument. Health insurance only pay for that. The first article is going to argue that too. He's going to say high deductible like $5,000. The second article is going to say high deductible like $100,000. A little bit different opinion. So we're going to talk about him. So we'll see. Very different views of what that a major event is. Most of it is group. Most of y'all can get this from your employer. Now, could you go to your employer and say, I want to have affordable care, the Affordable Care Act? Could you tell your employer, I don't want my insurance, I'm going to go to the healthcare.org? That'd be interesting to see. Could I cancel my UTSA insurance and say I want to go and get it from healthcare.gov? That's one thing you could do as other. Someone could go to healthcare.gov and just explore it and see what it's all like. What does it look like? One of my complaints on healthcare.gov. Have y'all been there before? I have no idea what comes up. It's .gov or .org? I think it's .gov, isn't it? They show these happy people, right? So easy, you just click on there. Some of y'all can educate me on this. My issue with the people I have talked to is it's too complicated. There's just too many options. I mean, there's too many options. What do people do? They buy the cheapest one. Is the cheapest one the best one? No. So I think that's part of the issue. In some states, there's just I don't know in Texas what it is. I'm scared to try in Texas. So I don't even know what all you can do on them. So if one of you want to say, I really don't like Medicare for all. For example, I went to healthcare.gov and I was looking through the options, and when the government takes over stuff, it's just too complicated, it's too bureaucratic. I don't know. Do y'all know people that are on healthcare.gov and what their experience was? Or some of y'all might be there. So I don't know. I just know I've seen articles. So this is more from articles. Too many options, too confusing. People just went with the cheapest premium. If that's the case, then it's not doing its job. I have sat down with people who had multiple options that help them, and it is ridiculously complicated. It really, really is complicated. It's almost too much. I'll show you some of the examples there. It's just too much. But Bernie Sanders say, forget all that. You all pay a premium. You're all on Medicare. His approach is fairly simple. My question is it fiscally viable? Medicare is already a fiscal disaster. Are they going to make it more fiscally responsible by having everybody on it? It's already a disaster with having 30% of people on it. So, we'll get through that. Group insurance does have huge advantages of having everybody on their employer plan. I'm going to argue to get rid of the employer plan, but still have the employer play a role in its buying power to maybe bring you some firms that you can buy from and use their buying power and say, hey, if you use this plan, you're buying it yourself. It's your insurance, but we'll bring you some carriers that you can buy from. That may not be a bad idea. Portability is an issue. We're going to talk about uninsured Americans, that they switch jobs and they lose their insurance. That's a main reason you might not want. We've had some federal laws that have tried to help with that portability. There's some question whether or not they work very, very well. Affordable Care Act, we will not get into it in details. So we're not going to have a big discussion on Affordable Care Act. We'll see some of it. Its goal was to address pre-existing conditions. That's the thing that made Hillary Clinton so upset, that what President Obama did, essentially took her, what he criticized her of, he then implemented in the Affordable Care Act, and then the Republicans kicked it out. We're going to ask about pre-existing conditions with Affordable Care Act if you don't force people to buy insurance. So we're gonna have to get into that issue. And rising medical costs obviously has been a huge issue in the United States. So whose problem, who's at fault? Is it doctors? Is it hospitals? Or is it pharmaceuticals? Again, what do y'all think is the biggest culprit in all of that? Y'all have any ideas? Who takes the brunt of it? Probably pharma, for good reasons. We're going to see why pharma is. I think you can see the article is going to argue that it's hospitals, but we'll see. We'll get into in some of this. All right, what is managed care? So let's talk about this HMO. This is not as much of a big deal today because they've essentially somewhat fixed all of this, so you really don't notice it. What managed care said was, the problem we have with healthcare is that people aren't getting their physicals, they're waiting too late, and they show up when they already have this really serious health crisis, and it's costing us all this money. If we could get people in the system earlier, you can catch things earlier, boy, that'd be a lot better system. It's kind of like auto insurance is going to cover all changes, because if you do that, your car is not going to malfunction and cause a major accident. So let's get people in to get oil changes. All right. There's some logic to that. President Obama made that argument. We have people not getting their medical exams and it's costing the system all this money. All right. I'm going to give you my argument against that. But that's what HMOs are saying. Let's give everybody insurance. And if they go to the doctor, we charge them $25. And so guess what happens all of a sudden? So we have managed care. You have a kid who obviously has a cold, but you can go to the doctor for $25, maybe $10. It could be some major plague, that 0.0001% of the world gets. Your kid might have that. You went on the internet, put in the symptoms, said it could be a cold or it could be bubonic plague. And you say, you know what, I'm going to go, it could be, let's go just in case. $10, who cares, right? You might get aspirin out of it. So that's great. You can get everybody else in the doctor's office sick from your kid. So what happened to usage? Boy, people started going to doctors. Now I remember I wasn't on the board, but I was one of the presenters at UTSA. And suddenly overnight, UTSA said, my word, healthcare usage has gone through the roof. We have this, so they had this, suddenly their healthcare costs just skyrocketed. What in the world is going on? This is crazy. When you tell people you can go to the doctor for any reason and you only have to pay $10, people said, why not? Let's just go do it. And people all became hypochondriacs. It could be some major disaster. And so UTSA moved from managed care back to indemnity. They told people high deductible policies. They forced them back to that. And guess what happened? Their healthcare costs dropped dramatically. So we're going to handle these issues. It is our HMOs. The very first article we're going to talk about, he's going to badmouth HMOs. He doesn't like them. Hillary Clinton got into a lot of trouble. The HMOs were the ones that undid her. They funded these advertisements because she badmouthed HMOs. And HMOs said, you badmouth us, we'll spend millions of dollars on advertising TV ads, and we will freak people out that you're taking all of their health care away. And that's exactly what happened to Hillary. So essentially the big complaint with HMOs is you had to use your HMO unless it was an emergency. And people are like, don't tell me what doctor I have to go to. And so that was the big debate went on back then. I don't care about these other ones. You really can't tell the difference in all these other ones. So I used to have to teach this. Now it's just like, it just doesn't matter. All right, so paper 2. Let's look at the rubric real quick so you can organize yourself. I want y'all thinking now. Let's spend some time here figuring out how you're going to prepare for this paper. I bet this is the longest rubric you've ever had for a paper. I don't know. We'll see. Can y'all beat me on a paper? That's a pretty long rubric, isn't it? All right, so if I were you, I would probably have a Word document open and already have these titles there. And I would start collecting quotes. And I would have the article I'm reading from open. So you can copy and paste that in there. And then you're probably going to need to say, wait, professor, I need to type some stuff. And just stop me. I'll be fine with that. So what you're going to do is technology as an example of distortions. All right, we're going to find some quotes on that. So every single industry in the world, technology has reduced costs, except for where? Healthcare. And healthcare technology is causing costs to go higher. Why is that? Well, there are exceptions. There are two parts of healthcare with technology have reduced costs. Anybody know where those two areas are? Any guesses? I've had one of them done to me. LASIK surgery. LASIK surgery is causing costs to come down. What's the other one? I have not had done to me, but I probably need it. Also here, I could do this, right? I look a lot younger. Cosmetic surgery. Technology has caused that to come down. What do you know about LASIK surgery and cosmetic? That's unlike most other healthcare. It's not usually covered by insurance. So technology, when insurance covers it, causes costs to go up. Technology, when insurance doesn't cover it, technology reduces costs. Does that tell you insurance causes distortions? So what happens in technology and medicine? It's these new fancy equipment, robotics, new MRI machines, all this kind of stuff. What does that stuff do? They don't cure us. They find more elements. And what do they find? They find cancers that will never kill us. Cancers they would have never found 20 years ago. Now they're finding them. So breast cancer, prostate cancer. A lot of those cancers are not dangerous, but some of them are. They have these new machines that are finding more of them. What do you think you're finding more of? The ones that kill us or ones that don't kill us? They're finding far more of the cancers that don't kill us. Why? Because they're so hard to find. So we're spending all this money to find stuff that's not going to kill us so we can have surgery to take out this cancer that's not going to kill us. If I told you you have cancer and you will never notice it the rest of your life and it will not shorten your life, would you have surgery to have that taken out? Even if you knew you had it. I've had some students say yes, but most people say no. Why would I do that? But if you go to the doctor and they say you have cancer, there's 1 chance in 14 it's going to kill you. There's 13 chances out of 14 it won't. Will you have the surgery? Now you got a problem, don't you? There's a guy at my church who had that, didn't have the surgery, and he ended up dying from that cancer. Yeah, he was one of the 14. So that's where technology, and we're going to get into that into the overdiagnosis. We're getting much better at detecting stuff that won't kill us, that we're going to have surgery to take out of us. All right. You see how I've given you like a million things in that one little line. And you gotta get all that down. Now, did I say that too fast for you all to type it all in? So you're gonna have to stop me to get those sub bullets down. All right.
Can you explain why they should be distortion?
Well, when insurance doesn't cover it, healthcare works like any other business. Technology reduces costs, so they reduce prices and get more businesses. When insurance covers it, it's like they pay for whatever. They just, there's a big distortion in supply and demand. So you as a patient, you're not paying for it. So you go to the hospital, what do you want? You go to the hospital and they say, you want us to use our best technology or our worst technology? What are you going to say? Hey, use the best technology. Yeah. Are you going to ask, is it more effective? What if you found out the most expensive technology is no better than the cheapest technology? What are you gonna tell them to do? Use your best technology. In fact, there's robotic surgeries. That sounds really good, robotic surgeries, but it's no better than the regular surgery. But it costs 10 times more. You go to the hospital and say, hey, we just spent $1 million in this new robotic surgery. Do you want the latest and greatest? The word greatest, what does that mean? They don't know. There's no evidence it's any better. What do you think the hospital wants to do? They want to use it, don't they? They got to pay for it. They just spent $1 million in this technology. So you see how insurance distorts this really, really badly. The health insurance company says what? We don't want to pay for that. And what do? You say, what do you mean you're not going to pay for that? You got to pay for that. So health insurance companies throwing their hands in the air. Hey, if we don't pay for it, we got all these complaints. What does the employer say? Well, we got to pay for more health insurance, and we'll just pay you less in salary. We'll pay for health. Insurance is a major distortion to this entire thing. That's going to be my argument. That's also going to be the argument of a lot of the articles we're going to read, especially the first two. The first two articles are going to say insurance is the problem. So insurance causes these. So you need to, under this technology, you need to talk about LASIK and cosmetic surgery. And there's some articles we're going to read that talk about how those costs are coming down dramatically. I haven't had Botox, but Botox is not all that expensive. I don't know if Botox would do much good for me. Y'all like to see that I'm angry, right? And you can't see that I'm Botox because I get all bent out of shape. But you know, it's a very profitable business, but it's also a business getting much more efficient. All right, so that's how we're going to handle this. So I'm going to try to help you to know where it goes in the rubric. One thing you can help me do, if I show you an article, you're like, where am I going to put this in a rubric? Some articles fit in 3 or 4 different places, so I have to kind of work through that. All right. I'll usually tell you, man, that's a quote I'd really use for overdiagnosis. I think this is just a perfect example of that, or that chart really works there. You're going to have some charts as well you want to bring in. Okay. So you have to somehow get all this. Unfortunately, I have it in an Excel document. You put this in the Word. I don't know how it copies over. It might work. No, I didn't want to do that. Paste special as important. That somewhat works, right? You can get it into the Word document. And so you have introduction, problem, and we'll definitely know if we're in the problem. I really spend most of my time on the problem, and then we spend probably the last third on the solution. Problem, solution. So we're going to go like that. So your goal as we go through here is to stop me. Professor, where are we? Where are we? What are we doing? What are we talking about? Okay. You want to write this paper as we go, as much as you can. And it actually won't, if you do that, it won't be that difficult on paper, because then you'll just start typing around your notes as you go off the top of your head. Okay. Everybody understand that there's going to be some students that's checking Facebook, and then they're going to have a 20-hour paper to write. They have to do it the day before. So everybody agree with me? This is the way we need to go. If you're sitting here anyway, you might as well make the best out of it, right? Now, do y'all need me to wait before we start so you can get that set up? Bring your laptops, all right? Some of y'all don't have your laptops. Bring your laptops. You definitely want to do that. So, all right, let me show you this first article. I'm going to let you out early because of the exam. So let me show you this first article just so you can kind of see what we're going to do. This first article really works extremely well for the introduction. So in the introduction, it's this part right here. What is an insurable event? That's what this first article is all about. He does a really, I know it's a really old article. I can't find a better one. He did in 2 pages what I haven't found other people doing. The second article does it, but he takes them like 30 pages to do it. So this first writer, very succinct, very to the point, very clear. So he's going to argue insurance is the wrong model. Why? Because health insurance covers, and you're going to see it, right in the beginning of his article. We define insurable event as something that is, what do we say earlier before? Is it high frequency, low severity, high frequency, high severity, low frequency, high severity? What do we say? Low frequency, high severity. Guess what he's going to say? Low frequency, high severity is an annual doctor visit, low frequency, high severity. No, it's high frequency, low severity. What is he going to say to do with that? He's going to say OOP. What is OOP? Out of pocket. Out of pocket. You hand them a credit card, they charge you a credit card, and you go home and it's all done. And you don't hand the credit card to pay your deductible, you hand the credit card to pay the entire bill, right? So you can see that's a big part. So you want some good quotes out of here for that part of the paper. So when we talk his article, he's going to spend some time here. He also has a solution. That's part of his solution. Insurance for high frequency, low frequency, high severity events, and medical savings accounts. That's his solution. So this first article is going to handle, it's really going to hit those two things more than anything else. So y'all see how I'm going to keep you where we are. We're going to go through the article. You'll be cutting and pasting those two places, but at least you know where those two places are. You can get to them really, really fast. All right. So you might work the word art 1. So when you're typing up here, blah, 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 and I say, let's go to the next part. You can do find art 1, and there it is. You're ready to go, right? You can find little tricks to get you around this thing as much as possible. I mean, you don't have to do that. I'm not trying to tell you how to do your paper writing. I might find articles during, I read The Economist all the time, and they have some really good, they haven't had good health articles since the Affordable Care Act. You're going to find the majority of my articles came during the Affordable Care Act debate. But there's some recent articles we'll find. Anytime I find an article, I will find it, bring it to you, and might add to it.